our next two panelists get up, I will just quickly introduce them. John Criss, who works in the Division of Securities, and Seth Hertlein. They are going to be talking to us about kind of an industry perspective on cryptocurrency and what's going on currently, and I'm sure lots of interesting things. So, Seth, John?
The hardest part is going to be figuring out where to sit. Well, good morning, everybody. My name is John Criss. I head our compliance section at the Ohio Division of Securities. Very happy to be here with Seth Hertlein. Seth is the Vice President and Global Head of Policy at Ledger, where he leads policy. And Ledger is the world's leading platform to secure cryptocurrency and digital assets. He has served on numerous boards related to cryptocurrency, including the Blockchain Association, and he currently serves on several, including the Crypto Freedom Alliance of Texas, the Pennsylvania Blockchain Coalition, and the Ohio Blockchain Council. Prior to Ledger, sorry, I'm just talking about you up here, but Seth led policy and government relations at Stellar Development. Prior to that, at FS Investments, and prior to that, probably most importantly impressive, at the Ohio Division of Securities.
Yes, indeed.
So, first question, Seth, and thank you very much for being here. I know that you're very busy, so we very much appreciate your time. Catch us up on your journey. We last knew you as the Ohio Division of Security control bid attorney. How did you end up where you are?
Well, I guess this goes back in time a little bit. 2014, I believe, is when I left the division. I went to help open the Washington office of a Philadelphia-based asset management firm called FS Investments. At the time, we thought that FS Investments was a leading alternative investment manager, but in hindsight, it looks very quaint. Registered investment companies and whatnot. A bit afield from the digital asset space that I work in today. But over my time with FS in Washington, I also shifted primarily from state regulatory to federal regulatory and ultimately to federal legislative. In 2020, a guy that worked for me at FS Investments actually, through a friend of a friend, became aware of an opportunity at Stellar Development Foundation, their first policy position, and he comes up to me and says, "Hey Seth, you want to go do crypto?" And I said, "No." I said, "That's a fad. That's never going to last." And he sent it to me anyway, and I read it, and I just sort of got curious, and so more and more I read, the more I wanted to read, and I guess eventually I just sort of tumbled down the rabbit hole and decided to take a flyer on this nonprofit foundation in San Francisco that was working on the Stellar Blockchain Network, which was at that time in 2020, that made me one of the very first dedicated policy people in Washington focused exclusively on policy. And it really gave me a front row seat to sort of watch the development of the industry, at least in its approach to policy. I often say that I wasn't early to crypto, but I was early to crypto policy. And I guess sort of the next thing that happened was summer of 2021. It advanced the Infrastructure Investment and Jobs. It was a 1,000-page infrastructure bill, but tucked in there was this tiny little pay for it that resulted in our infamous IRS broker rule and crypto circles in any event. So this was a provision that would require reporting for crypto transactions by brokers. Oh, sorry. I like to sit back in my chair. But it was not very clear on what brokers meant and left a lot of latitude to the IRS, who took things a little bit too far. And that was a sort of a collective wake-up call for the industry. So it was really sort of Q3, Q4 of 2021 saw massive investment in terms of digital asset companies setting up offices in Washington, hiring outside lobbyists, hiring internal policy teams, and there were so few of us to begin with. I mean, it was sort of a gold rush. I was getting multiple calls a week from companies trying to hire me because there were only like 5 of us, and it was probably the only time in my career that has and will happen. But I enjoyed it at the time. And one of those companies was Ledger. I was a Ledger customer. I had one of these guys already, so I was familiar with the company. And the more that I got to know about them, I was really intrigued by sort of the breadth of issues that they deal with. Because the products, and we'll talk more about it, is such a foundational product that customers, users, do so many different things with digital assets, from stablecoins to NFTs to DeFi and on, but they all use our product to do that. And so even though we're not necessarily in those businesses as a company, our customers use our products for those things, and so it means that we sort of have to care about all of those issues. And then secondly is the geographic scope. We sell into over 180 countries around the world, and so I joke sometimes that it means that I have to care about everything, everywhere, all the time. And I like that challenge. And so I ended up starting with Ledger in beginning of 2022. And, it's been I can't believe it's been almost 4 years already.
Yeah. So, and your work now, what sort of work do you do on a daily basis, or a weekly basis, or a quarterly basis?
Yeah, I'm not sure that I have a daily or a weekly basis. It's very different. So I oversee internal and external policy and regulatory teams across the United States, Europe, Middle East, and Latin America. And our work really sort of breaks down, I think, in 3 verticals: external advocacy, internal business advisory, and thought leadership. Although anymore you might add a 4th vertical for travel. I've been to 7 countries already since Labor Day.
Wow. And you mentioned that you had a focus on Europe, but I know that you were just in Mexico City this past week, and so you're focusing a little bit more on the Americas, it sounds like.
That's right. Many Latin American countries are really starting to get active on crypto policy.
Yeah.
And I think it's a tremendous opportunity there because a lot of those countries and populations have problems that a blockchain is very well suited to solve. And they also don't have as much of sort of a legacy banking infrastructure to overcome. So there's a tremendous opportunity there if the leaders get the policy right.
Great. So you touched on this a little bit, but can you just go over what Ledger is and what role it plays and its products play in this ecosystem currently?
Yeah, thank you. So Ledger's a French company. It's founded and headquartered in Paris in 2014. I know it's terrible. I have to go to Paris all the time. But 2014 was very early in digital asset days. Ledger was one of the first companies to really start building a business in the space. Prior to 2014, it was mostly sort of enthusiasts and tinkerers. While we're sort of very closely associated with crypto, we're not really a crypto company. We don't issue a token. We don't operate a network. We're not a custodian. We're not an exchange. We don't hold people's assets. We don't process transactions. We're really a consumer electronics company. So we manufacture devices that look like this that enable our customers to securely hold the private keys that control their blockchain addresses and therefore their digital assets. So it's primarily a security product, but in the form of a physical device. So we have a factory in France where we make things and we ship them around the world, and so it's actually a very sort of traditional business in that sense. But of course, our users use the product primarily for digital asset purposes. Although that is starting to change. Maybe we can talk about some of our new sort of applied cryptography uses that go beyond digital assets. It gives us this sort of interesting vantage point where we're very much interested in the development of digital asset policy, without being sort of a purely digitally native company.
The more jurisdictions that adopt blockchain and cryptocurrency, the more demand there is for products. Right?
Yeah.
Yeah, amazing. So let me take a step back and let's talk about the crypto world here. We had dinner last night, and so some of this will be a continuation of the conversation we were having. But let me ask first, if you could envision the world in 10 or 15 years, how does this technology, how will it play out in our markets? What will the future look like?
Well, so first of all, thank you to Debbie for going over all of the architecture and how it works. I can skip past that part. So thank you. The way that I really see it is very similar to the internet itself, and sort of the early days. Right, there was there's a .com boom, and there was a lot of hype, and a lot of people didn't understand how it would work. But there was still a lot of excitement, and if you remember back to to those days, or CNBC or those sorts of things, Wall Street Journal, everyone talked about the internet sector as if it was a sector unto itself. Nobody talks about it that way anymore, right? And so we sort of thought about the world in terms of there were internet businesses and then all of the other kind of businesses. Today, every business is an internet business, right? You can't really run a business that doesn't have some a use of the internet or internet technology. And so I think a very similar thing will happen with blockchain over time. I think eventually the use cases will become more clear, more obvious, and more ingrained in people's day-to-day lives. And and so eventually it will be sort of like the internet. Every company will be a blockchain company in some way, and we won't think about it in terms of sort of crypto and everything else.
Mm-hmm. Yeah, I mentioned this last night, but during our conversation, I was reminded of a clip I saw from David Letterman, where he was remarking that people on the internet had just streamed the first Major League Baseball game over the internet. And he was laughing about, we also have a thing called the radio, and the whole audience laughed, and you remarked very wisely, okay, if you could have been in that moment, could you possibly have envisioned that now we'd have phones, and we would have our whole lives, and social media, and every aspect of our lives that are wrapped up in that thing?
Yeah, I mean, I think, I assume most people in this room can probably remember the first time they ever dialed up to the internet and they heard that horrible modem screeching and everything, and, got to see some, website that looked like a third grader made it. And it's probably difficult sitting there and looking at that screen in 1994 and being able to imagine that one day you would just walk out of the building and pull a device out of your pocket, and 2 minutes later a car would show up and take you where you wanted to go, right? Like, you would never be able to imagine that one day this is how this technology would be used. And and I think that the sort of the caution there is, if policymakers had sort of rushed to regulate this new dial-up modem technology so early, maybe an app like Uber would never have been developed, right? And so I think there's some caution in sort of letting the tech develop and mature, because we may not know what the killer use of blockchain is yet. I mean, I suspect that I think, to me, the three most really innovative and useful, are Bitcoin itself for its monetary properties, stablecoins for commercial activity, remittances, payments, settlements, those sorts of things, and then NFTs for sort of the ability to provide to show clear ownership and authenticity of unique assets. And I don't think NFTs in the sense of like the monkey JPEGs, that is clearly that, but for more mundane things like land records and auto titles and that sort of thing are perfect for NFTs. So maybe it's those, but maybe it's something that we haven't even collectively envisioned yet as a possibility.
So maybe even the question of imagine 15 years from now is not fair, because it's transformative in a way that we can't envision now. So I've heard you say in other interviews that blockchain tech itself matters. Can you explain what you meant by that and why it matters specifically for the development policy?
Yeah, so I think this is a really important point, and I want to spend a little bit of time here. And again, thanks to Debbie, because did a lot of the work for me on this. But if crypto was just some new speculative asset for people to gamble on, like that wouldn't be, first of all, it wouldn't be new. It also wouldn't be very interesting. To me, I think that blockchain technology matters because it's this new architecture that overcomes an age-old problem of trust. What I mean by that is, what role do banks or brokers or other types of intermediaries play in the economy? It's really to overcome a trust problem. They lower the barriers to transact. And so if you think like way back in time, if two strangers didn't trust each other, they may not trade, even though it's in both of their interests to do so. But if there's a middleman that they trust, or at least trust more than each other, they might still trade, which of course is mutually beneficial, and this is the stuff that economies are made of. And so, clearly financial intermediation has been a tremendous benefit to society for hundreds of years, but it's not without its own problems. Banks sometimes cheat, they sometimes fail, they sometimes put their interests ahead of their customers, and they generally always charge high fees for what is essentially a bookkeeping service. So Bitcoin obviated a lot of this, and Bitcoin being the first sort of usable instance of blockchain technology. By creating this method where the sort of formerly secret ledger kept by the bank could be replicated across a globally connected, always-on network that anyone can see at any time and participate in. And I won't sort of go over the architecture again because Debbie did such a great job. But there are two main innovations that sort of flow from this from the individual perspective. The first is because of this distributed ledger, what that means now is that individuals can directly own and control their own digital property, much in the same way that they can physical property. And since sort of the digitalization of finance, the ability to do that had sort of been lost, right? All financial assets were pretty much held by third parties for the last 50 years or so. Before that, you could hold it yourself, but not really from the time of sort of digitalization until Bitcoin. So what that means is, if I can directly hold and control my own digital property, one, I can completely eliminate counterparty risk, and it gives me, just a lot more sort of sovereignty over myself and my own property. I don't have to go to a third party, which is typically a rent-seeking third party, and ask for permission to use my own stuff. Right, so that's number one. We call this concept self-custody, and that's really what sort of our business is, right? Our devices help people to self-custody securely. The second real innovation is that once I'm able to hold and control my own value directly, I can transact directly with someone else, peer-to-peer, without anyone in the middle. Being able to do that, again, increases my own sort of personal sovereignty. It increases efficiency, it reduces fees because it eliminates rent seekers, and overall promotes efficiency, privacy, and I think most importantly, freedom.
So you said that the three big future use cases that you can see are Bitcoin, stablecoin, and NFTs. So on the stablecoin side of things, and this is a little bit unfair because we were talking about this last night. This is not our pre, but you said something really interesting last night that I was hoping you could repeat for our crowd. So I was remarking about concerns I had about moving the entire banking sector. You said something that stuck with me about how stable coins are, in your view, and I don't want to repeat what you said, I'll give you a chance. Stable coins are not introducing risk to the banks, but instead you viewed it as banks introducing risk to the stable coins. Could you repeat that for the benefit of our audience?
Yeah, sure. So this is a question that comes up with policymakers all the time, particularly in Europe. There's a sort of presumption that because stablecoins are new, that they're somehow riskier than what came before, right? So the prevailing mindset is that banks are safe because they're regulated and we know how they work, and that stablecoins are not safe or less safe because they're new and we don't really understand how they work. But that's not the case at all. And from my vantage point, it's not that stablecoins introduce risks into the banking sector. It's actually the reverse. It's that banks into stablecoins. And the reason I say that is because of the difference between the two models. Stablecoins, as sort of enshrined in the Genius Act, but operating this way even prior to that, stablecoins are fully reserved. Right? That's the model. What that means is that should be, of course. What that means is the stablecoin issuer has at least as much in reserve in terms of assets as liabilities, right, or coins in circulation. If that is indeed the case, and it is important that that is the case, but if that is the case, then there should never be a run on the stablecoin issuer, because even if every holder of a stablecoin seeks to redeem at the same time, there should be enough assets to pay all of those out. So that's an inherently a safer model. It's fully reserved. The stablecoin issuers don't engage in lending. They should always have at least as much as they need to redeem every coin in circulation. Banks, of course, don't do that by a very long shot, right? The whole banking model is built on fractional reserve lending. At most, the regulatory requirements they have require at most 10% held in reserves. And so there is run risk there, right? You have to have confidence that in the bank. And if too many people withdraw their deposits at the same time, you have these, sort of cascading calamities like we saw in the 2008 financial crisis, and then more recently in 2023 with sort of the regional bank collapses, and most importantly, Silicon Valley Bank. And that one is interesting because there actually was a bank to stablecoin connection with that one. Circle, the issuer of USDC, held a very significant amount of reserves, I think $3.5 billion, in Silicon Valley Bank. Silicon Valley Bank failed, not because of anything having to do with Circle or stablecoins, but when it failed, obviously the insurance, the deposit insurance limits up to $250,000 don't do a lot to secure the stablecoin reserves of $3.5 billion, right? So there was real fear in the market that that the Circle would not be fully reserved. They would lose a big chunk of the reserves behind their coins, and that caused USDC to depeg from the dollar. The price, I mean, Circle would still redeem you at $1 if you went to them directly, but in the market, the price of the stablecoin went down to 68 cents or something like that for a relatively short period of time, and then it recovered. After the government, announced that it would backstop Silicon Valley Bank. But that's a clear example of risk coming into the stablecoin from the banking sector and not the other way around.
Yeah. It's a super interesting perspective. I'm sure that will generate some thoughts and questions from our audience, but I had not heard that perspective before last night, so I appreciate you impromptu repeating it for the benefit of our guests here. So you did talk, you touched on this a little bit, but I want to dig deeper. Can you catch us up on where the industry is now in the different frameworks? Debbie talked about this. We have certainly different states that have tried different things, but also globally, because I know that you're involved both Europe, in the Americas, and also in the Gulf states in terms of the development of policy. Just go over on a high level what the different approaches, the different frameworks look like among these different areas.
Yeah, so I think there's three that I'll focus on. The first, obviously, is Europe with MiCA, which was the first, not the first regulatory framework, but the first one, of a sort of a major economy or major bloc. The other one that's interesting is what's come together in the UAE, the United Arab Emirates, particularly Abu Dhabi and Dubai, which is a sort of a different approach that the industry seems to really like. And then, of course, the last one worth mentioning is the United States. First with Genius Act, and then perhaps with Clarity or market structure. Senate version is more likely, in my estimation, than Clarity. But so there are some important differences there. MiCA is very much misunderstood on this side of the Atlantic. Sort of no secret that it was very, very tough times politically for the industry over the last few years. And so I think a lot of builders in the space here looked sort of longingly across the ocean at MiCA and said, oh, wouldn't it be nice if we had something like that? At least they have Clarity over there. But I don't think they really understand what MiCA is. So MiCA originated as an effort to kill Facebook's Libra. I mean, they won't say that publicly, but I've had a number of conversations with folks over there, and they're like, we did that because of Libra.
Well, this type of insight is why you're here.
So it's a really protectionist measure, and it was really focused on stablecoins initially, and then after sort of Libra died on its own, it shifted a bit to be more comprehensive. But the problem isn't really with sort of what MiCA says. It's this, what I refer to as the millefeuille effect. So millefeuille is a delightful French dessert that's made of a bunch of different layers of like hazelnut cream and cake, and it's delicious. But in Brussels, they like to make regulatory millefeuille. Okay. And so MiCA is 174 pages, which seems pretty reasonable. But that's the layer 1 text, right? So then there's what they call layer 2, which is it's not really sort of regulations in the sense that we think of them in the U.S. It's sort of interpretive expansions that come from these European supervisory agencies, so ESMA and the EBA and others. Those are the level 2 for MiCA is approaching 3,000 pages. And then there are the level 3 texts. So each of the 27 member states in Europe has to individually transpose the regulations and then sort of develop their own implementation, right? So the layer 3s haven't even, they're just starting right now, but they're going to add several thousand more pages, right? So MiCA by itself will easily hit 10,000 pages. Wow. Before MiCA 1 was even adopted, the European Central Bank and some in the Commission and others were already calling for MiCA 2. MiCA 2 would be a new level 1, which would have its own level 2 and its own level 3. So that's just MiCA. That's not all that applies to digital assets in Europe. There's also a whole AML package, transfer funds regulation, AMLD, I think they're on 6 now, anti-money laundering regulation. There's tax treatment called DAC 8. There's a bill called the Data Act that applies to smart contracts. And on and on and on. Those are all level 1s that have level 2s and level 3s, right? And so it's just this crushing burden, this weight of regulation on businesses in Europe makes it really impossible to start and scale a company there. And so that it has this sort of perverse effect of sort of crushing or plowing under all of the native European startups because the cost per customer to serve a European customer is at least 50% higher than to serve an American customer. So you have to make so much more there, just even to sort of break even on a competitive standpoint with other places. What it does is it sort of makes Europe this like open field for larger foreign companies that can subsidize the higher cost in Europe with more profitable customers elsewhere, right? So it has this sort of perverse effect of making Europe a really great market for American and Chinese companies and a terrible place for European companies.
That's MiCA.
Okay.
And then we have the two other approaches of the UAE and then the US.
So the UAE is taking a really sectoral approach. Okay. So instead of a unified, comprehensive framework, well, first of all, the UAE is a fascinating place because there are 7 emirates that operate sort of like our states, but they're sort of a bit more sovereign. And then within each emirate, they have lots of different free zones. And some of the free zones set up their own regulatory agencies and sort of pass their own frameworks. And what that does is it creates this really fascinating market for regulation. Because if you don't like the regulation in one zone, you can literally go sometimes across the street and get a different one. And it means that the regulators there are really in tune to what the industry needs. And that's not to say that it's like this free-for-all and no regulation. Like they're real regulatory frameworks, and oftentimes very well considered ones. But what it does mean is that the regulators there want to hear from the industry. They want to know what works and what doesn't and why, and they want to try to fix it. And again, not to like just make it this like Wild West place, but to create a framework that works for the businesses, works for the population, and makes the UAE an attractive place to set up and conduct your business. And they have effectively done that, especially with the sort of the hardship the industry faced in the U.S. over the last few years. Many of them, and then the problems with MiCA, right? Many European and American companies have set up in the UAE for that reason. But in terms of the framework, the sort of the leading two is from Abu Dhabi, one of the free zones, Abu Dhabi Global Markets, and then VARA, the Virtual Asset Regulatory Authority in Dubai. And what they've done is created sort of different rule books for different types of activities. So you don't necessarily, you're not necessarily subject to sort of the whole thing in a comprehensive way like you would do with MiCA, but it's, say you want to be a custodian of digital assets. There's a custodian rule book, and you're just subject to that. And you can start there, and then you can say, you know what, I want to add trading or investment advice or whatever, right? And for each new activity, you just add that activity's rule book to what you do.
Based on how far you want to go.
Exactly, right? And so you can sort of tailor the rule sets that apply to you based on the business that you want to conduct. And companies seem to really like that.
Yeah. And then the third one is the U.S.'s market.
So the U.S. is still coming together. Obviously, we've got the Genius Act now for stable coins. I think whether market structure is a really important opportunity, and I really hope the Senate gets it right. There was a sort of this prevailing thought that the U.S. is behind. Mm-hmm. I don't think that's necessarily true, because most of this industry developed in the U.S. with a lack of any sort of regulation to begin with. Well, I should temper that. A lot of the activity is regulated, but not in a dedicated sort of crypto design framework. Yeah. And so it's not to say that sort of a regulatory framework is conditioned pursuant to the growth of the industry. That's obviously false.
Clearly been shown to not.
And so but that is the mindset in Europe, right? You have to have the regulation first before an industry can grow, and that's wrong, but that's what they think. Yeah. And so there was often this attitude of the U.S. is behind, we're getting farther behind, and you heard that a lot in the halls of Congress, and I think for sort of advantageous reasons for themselves, a lot of the industry would go to Congress and say that, but I don't think it's necessarily true. I think it was actually smart to sort of take time, let the industry grow and develop a bit, see some of these other models from different places around the world and what works and what doesn't, and then try to craft something that's particularly suited for our market, our industry, and our consumers. And so, hopefully that's what's happening now. It was really unfortunate what happened during the last administration. I think that was a lot of unforced error. But I think we're in a much better place now, and I really hope that the Senate is able to sort of get a market structure bill over the line before the end of the year.
Yeah, and that ties back to what you were saying initially about how you want to wait for the market to develop before you regulate it. Just like how if we had tried to regulate the internet sector in 1996, we wouldn't have appreciated what it could become about ordering Uber from your phone in 2025. So just on the sort of the patchwork of the different approaches that you're talking about, it reminds me a lot of when Debbie was going over what the states do. And when we have different states trying different things, it just becomes impossible. It creates regulatory arbitrage, it creates diminishing utility, it creates diminishing consumer protection. Is global coordination a pipe dream, or is there a world in which it can all work?
Well, I don't know. first of all, there will never be sort of complete global coordination.
Yeah.
I think global coordination is appropriate in some instances, like if you have, sort of criminal activity that crosses lines. Obviously, the law enforcement from the different countries should cooperate, and that just makes sense. But from a regulatory standpoint, I'm not sure that it does, and I'm not sure that it should. I think every country is different, has different needs. Every country's government has a duty to act in the best interest of its people, and so I'm not sure that there is this like global gold standard to which every country should be held to, right? So what's in the best interest of the people of Dubai is very different from that of the people of Panama, which is different still from the people of Denmark. And the leaders of those countries have a duty to find or develop a regulatory framework that puts their country and their economy in the best position that they can. In that sense, regulation is a market, just like any other market. Countries compete to attract business and to attract talent and to grow their economies and do all those things. And they have a right, in fact, to do that. So I sort of disagree with the premise that there is this sort of singular global standard. And then first of all, or second of all, I think companies also have a duty to their investors and to their customers to choose those sort of the regulatory environments that make the most sense for their businesses. I don't think you use the term regulatory arbitrage. I don't necessarily even agree that that's a thing or that it's a problem. I think just like countries compete and have a duty to seek the best interest for their people, companies compete and have a duty to seek the best interest for them as well. And so, and so I think they should seek out countries that provide a framework that makes the most sense. That's why we saw sort of Europe do what it does, and a lot of companies moved to Dubai because it saw an opportunity. I think that pressure is good, right? That creates some pressure for Europe to maybe rethink its approach. I don't think it will, but the pressure exists. And I don't think that's a bad thing. I think that's a sort of a self-correcting market working the way that it should.
Okay. So another sort of maybe unfair, because it's not in our list of questions, but I want to follow up on a conversation that we had last night that I thought was super interesting. Chesterton has this great quote about how if you come across a fence, you should never tear it down because nobody built a fence for no reason. As the crypto bills are advancing and market structure bill is being debated in the Senate, and it is, we're the Ohio Division of Securities, not the Ohio Division of Crypto, and we're talking about it because it's moving into affecting the securities markets and what our folks are seeing. But are we in a place where we are tearing down fences, or are we in a place where we're moving into new land, or is it something else?
No, I think it's probably some of each. I think it depends on sort of the specific examples.
Yeah.
I challenged you a little bit on that. Last night. I said, what fence is the Genius Act tearing down, for example? I'm not sure that it is, right? This is really a new thing. If anything, I think the Genius Act is more akin to building fences on virgin land, than the other way around. I think to continue on your metaphor, there are times when a fence serves a purpose, and then that purpose changes over time, and the fence is no longer needed. So, I think it's the creation of these sort of fundamentally new and different technologies that are truly transformative provide both the necessity and the opportunity to review sort of the existing frameworks and to decide, does this still make sense? Are we just keeping this because this is the way we've always done it? Or is this an opportunity to change and make something better, right? I think if we come back to Uber and the internet, obviously the market has spoken. People choose Uber over taxi cabs because they like the service better, right? Should we have denied that opportunity and said, you know what, taxis are the way to go. That's how we've always done it. We don't need this innovation here.
Yeah.
I don't think people would be best served by that attitude.
Yeah. So I have two more questions, and then I want to turn it over to audience questions because it's such a treat to have you here. But just a cultural thing with cryptocurrency growing up, in a sense. Now, I know that you, for example, it's common to hear the phrase "not your keys, not your crypto," and with Ledger being a device where you can store your crypto. It seems to me that there's sort of a maturing of the market that is meeting this almost philosophical framework. How do you, as a company, or you individually, how do you address that conflict? You've got sort of this purists on this one side, and you've got the market maturing into what it will be on the other side.
Yeah, I mean it's a great question. And I think you try to do both for as long as you can.
Okay.
Right. The market will inevitably mature. So crypto came up on this very sort of cypherpunk ethos of extreme individuality and self-sovereignty, and in many cases those are good principles. But there are also permissionless networks that anybody can use and anyone can build on, and that's sort of part of the beauty. But that's also how we now have nation states building up strategic reserves, and sort of the whole point of Bitcoin was to separate money and state, and now we have governments hoarding it, and but that was inevitable, right? When you build a permissionless system, people are going to use it for different ways. We also have sort of Wall Street and big banks starting to come in now, and I think if you talk to some of the original Bitcoiners, like that's like the most anathema thing to them, right? But that's the system that they built, so it's sort of inevitable. The system will mature, like I said. I think it'll just sort of eventually sort of fade into the background, and everybody will be using blockchain for different things and different reasons, and that's okay. But I think for as long as possible, and this is my personal view, we should sort of try to preserve those founding principles and that ethos for as long as possible, because I really believe that is sort of what makes the technology different and useful. Is its ability to empower individuals and to give them the ability to sort of take back some of that personal agency that's been lost over the years, either to governments or big corporations or what have you. And I think that's a good thing. Yeah. So I think we try to do both as well as we can.
I gave a presentation going over some basics of crypto. And one of the slides was talking about the cypherpunks movement and said what people thought cypherpunks looked like, and it was like crazy pink hair and people like surfing or whatever. Yeah, and then what it actually looked like is a bunch of dudes with like big laptops. Yeah. Last question. Okay, so let's jump back ahead 15 years and look back at 2025. How will 2025 be remembered for crypto policy? Do you think it will be, for example, the year that crypto grew up, the year innovation got strangled by bureaucracy, or is it just going to be another year that maybe we're making a bunch of now because we're in it, but we'll look back and it'll just be another year?
Well, I was hoping to get out of here without giving the traditional lawyer answer, but it sort of depends.
Right. We trained you well here at the Ohio Division.
So, I mean, you can point to a couple things. I think, if the Senate manages to get market structure done this year, in substantially the form that the discussion draft has been proposed, I think you can look back in 2025 and say, that's the year that, sort of not just, like I said, it started to grow up in 2021, but I think, if market structure gets done this year, maybe you say that's the year that it's sort of like graduated. you also mentioned bureaucracy strangling innovation. That is absolutely happening too, mainly in Europe, as you all know from my prior comments. That didn't start in 2025, but it's clearly still happening. So, so I think that will continue to go on. But I think what's really interesting is if we look outside of sort of the two big markets, it's what's happening everywhere else. And there's so much opportunity just for the nature of the technology itself, for smaller countries, smaller economies to sort of leapfrog the advantages that the developed world has, particularly in terms of financial services, and really put themselves on the map. And you saw this, sort of early on with Singapore and Dubai, because they're sort of small, almost city-states, they can move very quickly. But there's tremendous opportunity in Africa, in Latin America, in Southeast Asia for these countries to really embrace the technology and use it to sort of jumpstart their economies, their tech sectors, their finance sectors in ways that they couldn't do before because they didn't have a New York or a London, right? And so what I'm really looking for is like how does the rest of the world sort of seize this opportunity or not? Because it's not a guarantee, right? Like they have to really lean into it. And so I think, sort of looking back, one of the things that I would be curious to see is like, what does everyone else do?
I want to make sure that we're leaving some time open for audience questions. We just have a few minutes. If you have some questions or comments for Seth.
Yeah, Seth, question for you. So Bitcoin has been number one since its inception as far as number one cryptocurrency. Do you ever see proof of work blockchains go out of fashion due to its energy consumption?
No, I think the sort of the energy issue is sort of been solved. I think it was sort of a non-issue to begin with. It was an easy attack vector, but I don't think it was ever really a legitimate one. The banking sector collectively around the world uses far more energy than Bitcoin does. Increasingly, the AI sector uses a ton more energy than Bitcoin does. Nobody ever complains about that, right? So it was this sort of, if you were talking about Bitcoin energy consumption, you weren't really concerned about the energy. You just didn't like Bitcoin, and so you were just it was sort of a red herring argument. But Bitcoin energy consumption is already very green. I think it's globally it's over 50% renewable sourced at this point. Bitcoiners and the protocol doesn't care. Bitcoiners really don't care where the energy comes from. It's all about price, and so it incentivizes development of lower cost energy, which actually has a lot of knock-on benefits for people in different places around the world. Paraguay is a great example. They have gobs of excess energy from some really large hydro dams that's really underutilized. And so this has been sort of a boon to their economy because they can sort of now monetize this resource that they have in ways that develop a tech sector and sort of job development and really good ways for their economy that start from that resource. So I mean, I don't think Bitcoin energy consumption was ever a real concern, and over time it becomes less and less of one.
Unfortunately, we are out of time. If you have questions, Seth, I think you're being on for the rest of the day.
Yeah.
But please join me in thanking Seth for his time and his expertise.